Welcome to the Explainer. Today, we are diving into something that sounds, super complicated bank capital rules. But stick with me, because it actually explains this massive shift we're seeing in the housing market. We're going to connect the dots between these complex regulations and the real world challenge of getting a mortgage. Let's get right into it.
So, if you've been out there looking for a mortgage anytime recently, you might have gotten this feeling that something's different. It just seems like the big traditional banks aren't as big of a player as they used to be. Well, it's not just a feeling, it's a fact. And it brings up a really important question that we're going to dig into today. Seriously, where have all the bank mortgages gone?
And wow, this chart right here, this is the heart of the mystery. Just look at this shift. If we rewind to 2008, banks were behind about 60% of all new mortgages. Now, you fast forward to 2023, and that number has absolutely plummeted to just 35%. That's not a small change. That is a seismic shift in the landscape of American homeownership. And the story of why this happened is pretty fascinating.
Okay, so here's our game plan for this explainer. We're going to start with the vanishing mortgage itself. Then we'll trace it all the way back to the 2008 crisis. After that, we'll look at the industry's three-point plan to try and turn this trend around. And finally, we'll get into the huge dilemma this whole thing creates for regulators.
All right, let's start by digging a little deeper into this whole vanishing bank mortgage idea. Because it's not just about who gives you the loan in the first place. It's also about who you send that check to month after month for the next 30 years.
Now this is where it gets really interesting. We're looking at something called MSRs, mortgage servicing rates. It's basically the job of collecting your monthly payments. And as you can see, back in 2008, banks managed almost all of them, a whopping 95%. Today, that is completely cratered to just 45%. So not only are banks starting fewer loans, they're also getting out of the business of managing them too.
So to really get why it has happened, we've got to jump in the time machine. The 2008 financial crisis was a total earthquake, right? And in the aftermath, regulators built this whole new set of rules from the ground up, all designed to make sure a crash like that could never, ever happen again.
And at the absolute core of these new rules are capital requirements. The best way to think about this is like a mandatory safety cushion for a bank. For every single loan a bank makes, regulators say, hey, you have to hold this much of your own money in reserve just in case things go bad. It's a critical safety net, for sure. But the bigger that required cushion is, the more expensive it becomes for the bank to lend money out in the first place. And that brings us right back to those MSRs, that job of collecting payments. Well, regulators see that job as pretty risky, so they make banks hold a really significant chunk of their safety cushion against those rights. This has made holding and servicing mortgages way more expensive for traditional banks than it is for their non-bank competitors, who, by the way, don't have to play by the exact same set of rules. So here's the kicker. The world has totally changed since those capital rules were written. Other massive reforms that came after the crisis, like the ability to repay rule, completely banned the kind of ultra-risky loans that caused the crash. The mortgages being made today are just fundamentally safer, which is why the banking industry is now arguing that the rules designed for a much riskier era are, well, pretty out of date.
So what's the industry doing about it? Well, this isn't just a few banks complaining on the sidelines. We're talking about a united front. 8 of the biggest banking and lending groups have all come together to propose a major overhaul to federal regulators.
Their proposal really boils down to 3 main things. First, they want to dramatically cut that capital charge for servicing mortgages. Second, they're saying let's make the rules smarter by tailoring the size of that safety cushion to the actual risk of each loan. And third, they want to ease the rules on something called warehouse lending, which is the short-term cash that non-bank lenders need to issue mortgages.
And just look at how big of a deal that first proposal is. The current rule hits those MSRs with a 250% capital charge. I mean, that's just a massive number. The industry is asking to bring that all the way down to 100%. This one change alone would completely alter the economics and make it attractive for banks to hold and service mortgages again.
The other proposals really follow that same common sense logic. Let's make the rules match reality. I mean, they're basically arguing that a loan with a 20% down payment and mortgage insurance is way less risky than a loan with 0 down, right? So it shouldn't require the same size safety cushion. They're just asking for the rules to be smart enough to see the difference.
So when you put it all together, the industry's argument is pretty straightforward. The current rulebook is basically a relic. It was built for a different world to fix problems that, frankly, have already been fixed by other rules. And now they argue these outdated rules are accidentally creating a whole new set of problems.
And here's the part that really matters to all of us. In their letter to regulators, these groups warned that when the rules are excessive and don't match the actual risk, it directly impacts the cost of and access to credit. Let me translate that from regulator speak. It means mortgages get more expensive and a lot harder for everyday people to get.
Which brings us to the final and most critical piece of this whole puzzle, the incredibly tough spot regulators are in now. They're caught in a classic dilemma, a true balancing act between two really important and sometimes competing goals. This is the fundamental question they have to answer. How do you do your number one job, which is keeping the entire financial system safe and stable, without at the same time making it too expensive or too difficult for qualified people to buy a home? Yeah, there are no easy answers here. And make no mistake, this isn't just some academic debate. Top officials at the Federal Reserve have actually said out loud that they are actively considering recalibrations to these very rules. So, change is on the table. The only question now is, what's that change going to look like?
And that leaves us with the big question for the future. Look, the rules put in place after 2008 were designed to build a safer financial system. And for the most part, they worked. But if that safety comes at the cost of making homeownership harder to reach, have we maybe swung the pendulum too far? For the future of housing in America, figuring out how to strike that perfect balance, well, that might be one of the most important challenges we face.